Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Whitecap Resources stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Whitecap Resources is a Canadian oil company based in Calgary, Alberta, with operations in Alberta, Saskatchewan, and British Columbia. It produces over 74,000 barrels of energy per day, with 85% of production consisting of crude oil. It was founded in 2009. Let's get started with the model. This is a mid-cap company, 2.4 billion market cap. They're trading at $5.16 a share, and they have 467 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company had negative free cash flow in 2017, but positive the rest of the years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they had negative net income in 3 of the 4 years, positive in 2018. Their revenue increased a lot from 2017 to 2018, but has been dropping ever since. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is the gross profit. And that was $617 million in the trailing 12 months. It's been going down the past few years. Below that is their operating expenses, and then below that is operating income. That's $162 million. That's also been decreasing the past few years. The company has about $51 million of interest on their debt, and then they have a lot of other income and expenses, negative $3 billion in the trailing 12 months. This was due to a $3.2 billion impairment expense. The bottom line of the income statement is their net income. That was negative $2.2 billion. It was also negative in 2019, negative $156 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. The company does seem to be generating sufficient cash flow each year, about $250 million for the past 3 years. They did have negative free cash flow in 2017 because they invested so much in CapEx that year, $1.3 billion. The company issued $400 million of stock in 2017 and $600 million of debt. In subsequent years, they have been paying down their debt and buying back stock. The most important part of any business is their operating cash flow, because if you cannot generate positive operating cash flow, you don't have much of a business, because you cannot rely on debt and equity financing to run your business in the long term. Even though the company had negative $2.2 billion of net income, they still generated $670 million of operating cash flow. The way you calculate operating cash flow, it's net income, and then you have to add or subtract the non-cash items on the income statement. They passed through a $3.2 billion asset impairment. That's a non-cash item, but it brings down your net income. It makes your net income look really bad, but it doesn't affect cash flow. They also had $500 million of depreciation, and they had $700 million of deferred taxes. So it's important that you look at the statement of cash flows in addition to the income statement, because you'll get more information. There could be some years, like in the trailing 12 months, where it makes the company look terrible, but they actually did not do that bad. They just passed through this large asset impairment expense. A company should reduce the balance of its assets on its balance sheet if they're overstated. Of course, if a company keeps doing this, then that means they had an inflated balance sheet and the company was not worth as much as when you first invested into it. Companies can't get in trouble for inflating their balance sheet, so they need to continuously impair their assets so the information on the balance sheet is reported correctly. Let's look at a capital structure. $2.9 billion of equity, $1.3 billion of debt. They have 70% equity and 30% debt. And their WACC is 20%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.8 billion. We divide that by 467 million shares. And we get a calculated stock price of $8.21. They're trading at $5.16, so they're trading at a 37% discount. It's a buy according to the model. Simply, Wall Street's valuation is $5.42, so they're also saying the stock is undervalued, just not as much as me. The stock was trading over $11, but it keeps going down in price. The company has cut its dividend. It pays a 4% dividend yield, and it pays out 40% of its free cash flow. So it does have 60% left to invest back into its business or to build up its cash reserves. This company has a really high beta, 3.55, so the stock moves 3.5 times the market. The stock has gone down 3% in the past 52 weeks, much worse than the S&P 500. The low was 73 cents, the high was 541. And the stock is trading well above its 50-day and 200-day moving average. About 3 million shares are traded each day for this stock, and of the 467 million shares outstanding, 401 million are on float. 27% of the shares are held by institutions, and it has a pretty low short percentage, 2.16% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you have $9,700 today. If you did not reinvest the dividends, you'd have $10,400 today. If you invested $10,000 into this company in January 2011, you could have sold for $25,000 after about 3 or 4 years. But if you would have held on, you would have been in the red and you would have been down money. Their biggest shareholder is Sailing Stone Capital, 7.4%. Then Dimensional Fund, BlackRock, then 2 smaller shareholders. Let's look at the financial ratios. The average PE in the market's 11.1, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at negative 1.1 because they have negative net income. Price to sales is stock price over sales per share. They're at 1.8, so they're doing really well in this ratio. That means investors are paying $1.80 for $1 revenue. Price to book is stock price over book value per share. They're at 0.8, so they have a really good price to book ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on a balance sheet, and they have $2.9 billion of equity, $2.8 billion of tangible equity because they have $122 million of goodwill on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments more than 3 times. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover 80% of their current liabilities with their current assets. So the company does appear to have enough cash to run their business over the next 12 months because they did generate $248 million of free cash flow. They had negative $37 million of working capital, and they had a $27 million dividend payment. The best way to look at ratios is to compare them to similar companies. I've done videos of 11 companies in the same industry as Whitecap, and if Whitecap has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE, even though they're negative. Their negative is a little better than the average. Price to sales are doing much better than the average. They're doing really well in price to book. They don't have a good current ratio. They have a terrible ROE because of that big impairment. They are pretty low in debt, but a little worse than average. And they're smaller than the average company, 1.8 billion market cap. Average is 8.5 billion. But they do pay a high dividend, 4.14%, much higher than the average in the industry. So to summarize, I have them trading at a 37% discount because the company is still generating pretty sufficient free cash flow. It is a little concerning that their revenue has been decreasing the last couple of years. But given that, they seem to be operating an efficient business, and they do provide a product that's really needed. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.